Welcome to the deep dive. Today, we're doing something a little different. We've got a standard microeconomics textbook in front of us.
Right, the kind of thing you'd see in any college course.
Exactly. But we're not going to treat it like an academic theory. We're reading it as a practical manual.
A manual on system mechanics,
Yeah.
on how power actually works.
We're ignoring the jargon, the stated intentions, and we're just looking for the underlying code.
We're applying 4 analytical lenses
Yeah.
just to see what the machine is actually doing, not what it says it's doing.
Lens 1, incentives, what really drives behavior. Lens 2, information, who has it and how do they use it.
3 is risk transfer. Who gets the upside and who gets stuck with the bill. And 4, regulatory distortion. What happens when you try to jam the signals?
So think of this as getting the diagnostic codes for the economy.
Yes, we're just looking at the pure operating system logic.
Okay, let's jump right in with lens 1, incentives versus narratives. We start with the classic theory of the firm. What our source material shows is that a company, well, it doesn't matter what its mission statement says.
Not at all. It's a survival mechanism.
Yeah.
It has one job.
And that is?
To maximize profit. It has to, by choosing the best mix of inputs, labor, capital, whatever, based on their prices and its own constraints.
It's just a constant process of optimization.
The only way to survive long-term is to find that sweet spot where marginal cost equals marginal revenue. Every single decision, every product launch, it's just a tactical choice to get to that point.
The source brings up Ford Motor Company. It's a great example. They make everything from, these efficient EVs to massive SUVs.
The Expedition versus the Explorer, for example. The decision on which one gets more factory space, more money, more engineers, it's completely unsentimental.
It's just a math problem.
It is. It's about maximizing profit under the constraints you have right now, like your cash flow and your factory capacity. If that high-margin, gas-guzzling SUV is the best tactical move today,
then that's what they have to do.
That's what the system requires them to do.
So what this means for you, the listener, is that Ford's narrative about, say, building the future of mobility, that will always come second.
Always. It yields to the tactical need to sell what makes the most money today. The profit signal just overrides the corporate narrative every time.
And this cold calculation gets even more stark when you look at something like exhaustible resources.
Oh, absolutely. Think about a major oil field. The owner has this one, critical choice.
Do I pump and sell today, or do I leave it in the ground?
And you'd think that's about geopolitics or climate change.
But the math tells a different story.
The math is incredibly simple. You compare 2 numbers. First, the growth rate of the oil's net value, so the price minus your cost to pump it.
Okay, and the second?
The interest rate, what you could get just by putting that cash in the market.
So it's a simple opportunity cost analysis.
Precisely. If the oil in the ground is appreciating faster than the S&P 500, well, you leave it in the ground. It's a better investment.
And if the market offers a better return?
You liquidate immediately, take the cash and invest it. The decision has nothing to do with global energy needs or conservation. It's a clinical comparison of growth rates.
That one decision just lays bare the entire logic. It's completely detached from any moral or long-term consequence. Okay, so if the whole system runs on these pure, clear price signals, bring in lens 4. Regulatory distortion.
Right. What happens when an outside force, usually the government, starts injecting noise into that feedback loop?
And we're looking at these interventions just as well as failures in the loop.
And they always create a predictable kind of fragility, a societal cost that you can't get back, what economists call deadweight loss.
The source material gives a fantastic historical example, the natural gas price control of 1975. Now, the stated goal was, of course, to make energy affordable for people during a crisis.
The stated intention is irrelevant. The system only feels the signal change. The government set a price around $1, but the real market price was closer to $2.
So you've just cut the incentive to produce in half.
You're telling producers, stop looking for gas, stop supplying it. The profit just isn't there to justify the immense cost of extraction.
So the result wasn't cheaper gas for everyone.
The result was no gas for everyone. It created a paralyzing shortage, an excess demand of 7 trillion cubic feet. The price cap destroyed the signal, and the market just failed.
A classic price ceiling. But we see a similar thing, maybe less obvious, with trade restrictions, like the U.S. sugar quotas.
Yes.
The narrative is always about protecting farmers, but our lens reframes it as a simple cost transfer mechanism.
It is. It's cost shifting on a grand scale. By blocking foreign imports, the rules inflated the U.S. sugar price to sometimes double the world price,
And the net effect.
a staggering loss to U.S. consumers. The text cites about $2.4 billion in 1 year alone, 1997.
But here's the really cynical part. Where does that money actually go? It doesn't just vanish.
No, it doesn't. When you break down that consumer loss, a huge chunk of it, what we call the economic transfer, it doesn't even stay in the country.
It goes where?
It becomes this massive accidental windfall for the foreign companies who were lucky enough to get a quota license. The regulation didn't kill the profit. It just shifted who got to capture it. It handed arbitrary wealth to someone just because they held a piece of paper.
That's fascinating. So government intervention doesn't stop the game, it just changes the winners.
And this brings us to systemic fragility, especially with essential services. Think about utilities under what's called rate of return regulation.
These are monopolies, so their prices have to be approved by a government body.
And the core problem isn't the regulation itself, it's the speed, or really the lack of speed.
Bureaucracy.
It's the regulation lag. Say there's a global oil price shock. The utilities costs explode overnight, but they might have to wait a year or more for the government to approve a price increase
So they're forced to operate at a massive loss.
for long periods. This delay in the price signal injects incredible instability into the most essential services. The whole system becomes brittle just because the timing is off.
So if government interference creates noise by breaking the price signal, let's look at what breaks it from the inside. That brings us to lens 2. Information asymmetry. It all comes down to who knows what.
It's a power dynamic. If a market needs perfect information to work, any inequality creates a struggle. Who's trading on the real signal? And who's just trading on noise and ignorance?
And information becomes the currency of power.
And that asymmetry leads to predictable failures. The classic mechanism is called adverse selection. The textbook example is always the market for lemons.
Used cars.
Used cars. The power dynamic is crystal clear. The seller knows if the car is a gem or a piece of junk, a lemon.
The buyer has no idea.
None. So facing that uncertainty, what does the buyer do? They rationally assume the car is of average quality. And that assumption drives down the price they're willing to pay for any car.
And the consequence of that is what?
The people selling the high-quality cars, the gems, can't get a fair price. So they just pull their cars off the market, they leave.
So the market becomes flooded with lemons.
Exactly. And potential gains from trade, good deals that should happen, are blocked. The buyer's lack of information just paralyzes the whole system.
And this isn't just about cars. It plays out in massive markets, like health insurance.
The insurance market is a perfect reversal of that power dynamic. Here, the buyer, the patient, is the one with the secret information.
They know their own health risks.
They hold a signal. They know if they're high risk, and they can exploit that by buying insurance right when they think they'll need it. That is adverse selection.
So the person with the information, the high-risk person, basically socializes their personal risk onto the entire group.
And it drives up the price for everyone in the pool. So what do the healthy, low-risk people do? They see the premiums climbing and they say, this isn't worth it for me, and they leave,
Which concentrates the risk even more.
pushing the price even higher. It's a death spiral that can make the entire market collapse.
Okay, let's turn this lens on one more thing. Education. We think of it as learning, gaining skills.
Human capital, right. But the sources analyze it in a different way, as a costly competitive signal.
A signal for what?
A way to solve an information problem. A high productivity worker needs to prove to an employer that they're better than a low productivity worker. The employer can't tell just from an interview.
So the college degree isn't the toolkit, it's the filter.
Precisely. The fact that you successfully completed a difficult, expensive 4-year degree signals something important. It signals that you have diligence, intelligence, persistence, traits that correlate with high productivity.
Even if the actual classes you took are totally irrelevant to the job.
Doesn't matter. The power of the signal is what gets you the higher salary. Not the knowledge itself. It's just a very expensive sorting mechanism.
All right, let's go to our final lens. Lens 3, risk transfer. We need to stop calling things like pollution externalities as if they're some kind of market accident.
They're not accidents. They are calculated cost shifting.
The goal for the agent is simple. Keep the profits for yourself and push the costs and risks onto somebody else.
Usually the public. This is maybe the most critical lens for understanding power. Take industrial pollution. A firm will produce goods right up to the point where the price equals their private marginal cost.
Their internal costs, labor, materials.
Right. But that calculation conveniently ignores all the external damage.
The cost of cleaning up the river or the healthcare costs for the community.
Exactly, the external cost. The firm maximizes its own profit by producing way more than what would be efficient for society as a whole.
So they get private optimization by pushing the cost of their waste onto the public balance sheet.
It's a wealth extraction mechanism. They take a public resource, like clean air or water, use it as a free garbage dump, and force everyone else to pay for the cleanup.
And we see this same pattern in the tragedy of the commons, the classic example being a shared fishery.
It's driven by perfectly rational individual behavior. Think about one fisherman. He's incentivized to catch as many fish as possible.
Because he gets 100% of the profit from that extra fish he sells.
But he only bears a tiny fraction of the cost. The cost being the depletion of the shared fish stock.
His personal gain outweighs his share of the collective risk.
Completely. So his private math overrides the collective good. He keeps fishing, and so does everyone else, until they collectively drive the entire resource to exhaustion. The system allows the cost to be socialized, so the private agent just keeps extracting wealth.
So to recap, we've run the diagnostics. Agents follow the pure signal of profit, period.
And the system breaks down when those signals get distorted by regulation.
Power struggles are all about who holds the information.
And private gain is often just a story of socializing your costs.
Every market interaction you're a part of, from reading an online review to the price of your electricity, it's all governed by these four mechanics.
The system is running this code everywhere, all the time.
Which brings us to the final, maybe cynical question we have to leave you with. We know the competitive process is supposed to lead to efficiency, but it's clearly very fragile. So which poses the greater long-term risk to the stability of the whole system? Is it private agents exploiting information and shifting costs? Or is it governments trying to override those fundamental price signals with their own intentional distortions?
Which one creates the most dangerous, long-lasting noise in the system you have to live in? That's something to think about.